Brokers Alliance and the National Insurance Clearinghouse present the Business Insurance Zone, a Bravo video event. Broadcasting in HD 1080p on Vimeo, YouTube, the Insurance Newsnet, Agent Navigator, BrokersAlliance.com, and on Facebook, LinkedIn, Twitter, and the Insurance Forum. And now your host, the whiz of the biz, Steve Savant. Well, welcome everyone to the Business Insurance Zone, the talk show that spotlights insurance in your practice, keeps you up to speed on insurance news and products, features insurance strategies from top advisors. Get in the zone, the Business Insurance Zone.
Our email address on the show is thebiz@brokersalliance.com, or you can call us 1-800-290-7226, extension 147. And I give you those two so that you can do any of your life quotes, any questions you have on disability, long-term care, annuities, or group pension plans. Those are your numbers you want to call in today. We're across the board on all these products. We're one of the leading distribution for insurance products in the nation, and I want you to be able to have access to all the things we're talking about, including a video show like this. And we're in the Business Insurance Zone, and with our disability expert today, and that's Marcy Pruitt. Marcy, welcome to the show.
Thank you.
And again, if you want to talk to Marcy after we get done talking, you say, hey, I have questions, I need to go through this. You can write her at marcy@brokersalliance.com, or just call her 1-800-290-7226. Her extension is 126. Well, on other shows, we were talking about different aspects of disability, because you are all that is disability, okay? The diva of disability, I might add. Today, I want to talk a bit, hone in on both segments on individual DI, not business DI, not group DI, not guaranteed issue, not simplified issue, kind of a group, straight up individual DI. Now, I've heard you teach on your video vignettes that are posted out on Agent Navigator, our site, just basic ideas. You talked about, underwriting. You talked a few ideas that I want to make sure we repeat today, because we want to get into this, but I still have to kind of set a little backdrop. When I'm looking at individual DI, the normal person who's going to pay for it himself, he's not on a plan that has a group DI. He doesn't have an employer picking up the tab. But let's say, and remember, this is the most entrepreneurial environment we have ever been in. So I think we're talking S Corp, LLC, a couple of guys doing a partnership, getting Ks at the end of the year. You know what I'm saying?
Right.
Basic stuff. And people that are out of their garage or whatever, right? But they have 2 or 3 employees. They have business going out. They have a nice practice. They're making 6 figures. And we come to them and say, I've never really approached these guys because S is a pass-through. LLC is a pass-through. The K is a pass-through to the partners. Is it really worth me, again, I'm not talking business, but for individuals who maybe own businesses, is this an area we should be looking at?
Absolutely.
We'll talk about it.
And especially the small business owners, the entrepreneurs. I mean, the larger corporations typically have some underlying LTD through their employer. There's always room to put more on top. But with those individuals, all that income is covered. The K1, the W2, any money that was left in the corp for whatever reason, the percentage of that due to their share of the ownership, commissions, bonus, all income, pass through or not. That is.
Did I hear you just say, you didn't say the word, but retained earnings?
Absolutely.
Well, that is.
If they're leaving it in the corp and
which they are.
Right. Then let's say it's a 50-50 ownership, then half of those retained earnings would be insurable for the owner.
For disability.
Right.
So let's make sure we got it all. Partnership income, retained earnings, right? Their normal W2, if they're pulling whatever their income is. K1 for partnerships, yeah.
Even the case by case, if there was a large 179 write-off, that can be credited back.
So even if they're deducting things under Section 179 of a personal nature, that could be brought back in.
Can be.
As a we don't know if it will be.
Exactly.
But it could be a calculation.
Right.
Right. And remember, don't rely on us to do the calculation for you.
Right.
Always talk to your legal or your tax advisor. And if you're with a broker dealer, of course, always ask your compliance officer, hey, what's our stand on this? So we always want to bring out, though, I love this, though, that's a kind of an all-in. Now, let's say I have my retained earnings, I got my K1 form, I got my W2 part of this, and maybe some of this Section 179. Now that's my total income. Now I have the number that I want to cover as an individual.
Right. And even if you're deferring into a pension or profit sharing or something, that can even be put back in.
So even contributions to a qualified plan.
Right. Because you could take that as income, you're deferring it.
So can I use the word, is deferral a bigger umbrella word for this?
Well,
for our
we're looking for the
advisors?
paper trail. How much money is attributed to you in this corporation, in this entity? And if there's a paper trail on where it's gone and legitimately so, then that counts. That's your earned income.
So my earned income, even if it falls under deferral, 401k, defined benefit plan, whatever I'm deferring, you're saying that in that calculation for DI to look at what are you totally making? Well, I didn't know that. And by the way, do you have a nice sheet or some kind of propaganda piece attachment that kind of outlines these
We
basic
do,
ideas?
I think we have a piece that would not only outline based on the entity what is covered, then what documentation is needed to support that as well.
Okay, can I make sure I understand? So you'll have a document just for S corps, the docs you're going to need, the information you're going to need
Right.
to assess income.
Right.
And that, whether it's S, it's going to be separate, LLC, or
C corp, sole proprietor partnership, right?
C corp. Okay, so and we have this. It's kind of a nice digest grid, right? Kind of a cliff note version.
Absolutely.
Well, again, you can call Marcy at 1-800-290-7226, extension 126, or just go ahead and write her, Marcy at brokersalliance.com, and we'll send you that.
Okay, absolutely.
Excellent. I love free. Okay. Now, so I have my income. I've calculated for individual DI. I have my income down now. I've looked at these different silos of income. Okay. Now I have my income, and I'm going to buy this now. I'm an individual. I'm not a corporation. It's a pass-through. Is it worth looking at the word deduction of premium for DI?
Well, if you are not a C corp, it is not deductible for the owner. If the owner were to purchase it on key people or any employees, that would be a business deduction. But the good and the bad, it's not a deduction for them, but it's also a tax-free benefit when the benefit comes in.
I've seen male spouses, sell their business to their wife, recharacterize themselves as 100% W-2 non-owner. Is that going to fly, or is that kind of a artful dodge?
Well, we see a lot of businesses owned, jointly, or one's not taking Social Security, or one owns it all, and one's taking the income for various reasons. And that will hurt you at the time of underwriting. Just like a sole proprietor, we look at the Schedule C. So even if you own the business and you're married, you take $100,000 home, it all goes to the household, we want to see your W-2 or your split, your share, your K-1.
So there's it's still, we have to look at this as a legitimate accounting practice, not an entity or recharacterization, I think would be the better word, recharacterization of either employment or ownership.
Right.
So that I can really look at this fairly. So, okay, we're going to have to stay above the board.
Right,
Okay.
absolutely.
All right. So now I have my income. I know what I can do now with it. You just told me that. I can't really deduct it for myself as the owner, but if I put it on any of my key personnel, that's okay.
Right.
All right, now let's say I keep it. Now, if I have a disability now, mine comes in free.
Tax-free.
Is that correct?
Right.
Am I still at a cap? What's the cap that I can do? I've added up all my income sources and my deferral incomes, like you said I could do, and now I got a number.
It's typically, the higher you make, of course, the less the replacement ratio. I mean, if you're making $1 million a year, showing taxes on $1 million earned dollars a year, then you're going to be at around 40%. The rule of thumb for anything under 600,000 is roughly 60 to 65% income replacement, because that is what you bring home a little more than that when you're healthy, working, and paying taxes, is the rule of thumb.
So if I'm pulling down $1 million, and I'm hoping that my boss is listening to this show, if I'm pulling down $1 million, because right now I can get 65, but I wouldn't mind making $1 million and only taking 40 if I was disabled. I'm hoping he's listening to the show right now. But
for that discretionary income, the actuaries don't want to insure that.
okay, well,
Although
I understand.
go, we mentioned Lloyd's, you can go to surplus lines and they don't have a limit. Or they have a 70% limit.
So you could go up to. By the way, everybody, when I think of Lloyd's of London, one of the oldest insurance carriers, I mean, these are like 350 years old. I mean, they've been forever. Do they do much in DI, or is it just mostly surplus? Now that you brought it up,
Well, it's surplus, but it's DI. I mean, you would always exhaust your traditional market first.
and then go to Lloyd's.
And then go to
of Lloyd.
Lloyd's.
Okay.
So why
So
we
if
say
you had something
surplus.
really like a high-end earning client, like
Right.
we've just mentioned, and or something really strange and anomalous in the client's scenario.
Right.
And how do I
Which
know?
can be age, which can be travel overseas, which can be medical conditions, high net worth, unearned income, because all of the above, the traditional carriers frown upon.
So if I wanted to know if I should go that way, I can just call you on that,
Absolutely.
1-800-290-7226, extension 126, or write Marcy at brokersalliance.com. I keep repeating it every show because some people actually will remember it or jot it down the third or fourth time. Yeah, we're a repetitive educational program. Well, now I have my 60%. I know what I'm doing now with 65, maybe more if I want to go to Lloyd's for the surplus lines.
Well, you also bump up against the carrier cap. So even when we say 60, 65%, if you have other coverage in force, if you have group coverage, and each carrier has a issue limit of, like I said, 20,000 is the typical industry limit, and then they'll go up to 30 or 35,000 with group or whatnot. But they also have two columns. They have the taxable column and the tax-free column. So what we've been discussing is a tax-free benefit. If it were a situation where your employer's paying the premium or you're an owner of a C Corp, you can, and it's going to be a taxable benefit, we'll sell you more because we're going to, the net result is the same. After taxes, they want you to have around 60%.
And we're going to do a whole show on employer and corporate DI. That's going to be a whole nother scene, And so when I'm talking to an individual, I got my silos down here. I got all my earning ability, what I make to calculate. And I also see that I'm going to make about 60, 65% if I'm making about 600K or below. So I'm trying to figure out how I'm going to prospect for this, how I'm going to market to this. That's why I'm kind of looking at this, looking at how we're going to do this.
Right.
Well, listen, when we come back from the break, we're going to continue our talk on DI and individual disability with Marcy. You can write her at marcy@brokersalliance.com or just call her 1-800-290-7226, extension 126. And don't forget, you can always hop on our website, www.brokersalliance.com. You're listening to the Business Insurance Zone, the talk show that spotlights insurance in your practice. We'll be right back after the break.
Steve Savant here. For years, I've heard that less than 2% of all term life insurance ends in a claim. That's not many, and clients had to die to receive the benefits. That's the old term insurance. Now start selling the new term insurance. The term insurance that covers your client through a chronic illness, a catastrophic event, or a terminal diagnosis, and pays their monthly premium during extended